Hey, hello everyone. This is Professor Choi again. Today, I'm adding another video to my Investing for Beginners videos. I wanted to have a conversation a little bit about what makes the price of a stock or what determines the price of a stock. Now, how exactly is the price of a stock determined is what we're going to be talking about today. So, theoretically, this is actually pretty simple. You can use any sort of supply and demand analysis to basically understand whether a stock is supposed to go up or down, in the sense that we can basically say, well, if there's more buyers, then the price should go up. If there's more sellers, then the price should go down. This kind of stuff is fairly simple. Now, if for whatever reason a company decides that they're going to issue more stock, assuming everything else stays constant, then the expectation is that the price of the stock should go down. Now, something that a lot of people don't quite understand, at least that's the reason why I'm titling this Beginners, is that there is a certain amount of stock outstanding at any point in time. In other words, the quantity available of stock is fixed to a certain quantity by the amount that has been issued over time. Companies have the ability to issue more stock. And if they issue more stock, they basically keep that money. So if they issue brand new stock, they can do it basically in the market, and they'll say, let's say the stock is trading for $10, they can say, well, we're issuing stock at $9.50, for example. Okay? Usually, it'll be usually a little lower than what market price is, so that they know that they can basically clear whatever they're in the process of selling. But companies can issue more stock, and of course, when they issue more stock, assuming everything else stays the same, then the expectation is that the price is going to go down, because there'll be an increase in the amount of stock, and therefore the company will be worth per stock a little bit less than before. Now, if for whatever reason a company says that they're going to be doing what is called stock buybacks, then a stock buyback will make the price of the stock go up, because, again, assuming everything else stays the same, it will make the price of a stock go up because the company becomes part of demand. In other words, now they're taking some of that and they're increasing basically the price of the stock by buying more stock themselves. This is one of the reasons why at least a lot of people on Wall Street, they like when companies announce stock buybacks. And normally when a company announces stock buybacks, then they won't just buy like one time. They'll basically do it, quarterly. They'll be like buying different amount of stock with the cash flow that the company has. So anyways, theoretically, it's actually fairly simple to try to figure out when the price of a stock is going to go up and down. Now, when this is actually going to happen, that's a little bit more difficult to figure out. Alright, the other thing I wanted to explain today is how exactly do you get a price for the stock, even though there is no such a thing as one price for stocks. And this is where it starts getting complicated, but it actually gets easy in the sense that if you understand that behind the scenes there is a computer machine basically trying to figure out a particular price going up and down, then it's not too hard. But the way the market actually works is out there is what we call lots of bids and lots of asks. A bids is basically an offer to buy. So it's like somebody saying, well, I want to buy 200 stock at a certain price. And then there are a lot of asks. Asks are basically people who want to sell. So these are people saying, well, I'm going to sell it, but at this price. Okay? Usually, the asks will be higher and the bids will be lower. Otherwise, the market will be canceling itself. In other words, people will be saying, okay, I want to sell $2,000 of this particular stock at $5.50 each. But then people who will be buying will basically say, no, I want to buy 1,000 at $5.40. Now, what exactly is the market price? Well, the market price is basically the sort of average of the closest bid and ask. And that's what we all see as the quote-unquote price. Okay? So the computer is constantly basically adjusting, depending on the amount of bids and asks that are in the system, is constantly adjusting that market price. And that's why if you're looking at a price of a stock, you're going to see a brand price quoted. But if you really look at the order flow, behind the scenes, especially when you're trading, you're going to notice that there is no such a thing as one price. The price is constantly changing and it's constantly being updated with different quantities for different people. Okay, so basically there's a lot of asks and bids behind the scenes. The bids are people who want to buy, the asks are people who want to sell. Of course the sales will be higher than the ask, and then market price is in the middle. Okay, now imagine that somebody puts in an order. So let's say you say, well, I want to buy at market price something, a certain amount. Well, what's going to happen is you're going to execute at this price, because this is the closest ask and you clicked market order. So you're going to buy market basically means you click and you're going to buy at the lowest basically ask that somebody wants. Now if you click I want to sell right away at market, then what's going to happen is you're going to be given this price right here. Alright? And again, the spread gets closer and closer usually the more order flow there is. The slower the order flow, then usually the wider the spread gets. Alright, how about limit orders? I'm usually one of those people that recommends that you should be doing more limit orders than you should be doing market, because a lot of the times market doesn't give you the best price. It basically just goes down to the bid and just selects that one, but there could be people like, you know, putting in the order at a certain time, and you will know that prices fluctuate pretty much during the day. So you could actually get a more solid price for what you want if you put a limit order. So what exactly is the difference between a market and a limit? So a limit order is basically when you're saying I only want to buy it at this price or lower, or I only want to sell it at this price or higher. Alright? So basically if you say I want to execute a limit buy, you can say something like I want to buy 2,000 of this stock, but at 535. Okay? And then what's going to happen is as the price fluctuates during the day, you know, as there are more asks and then more bids, then basically we'll only execute at 535 or lower because you're buying. Okay, so if the price goes down to like 534, it would execute. If it goes down to 533, it would execute. Okay, now again, if you put a limit buy, it would only buy at that price or lower. Now, what happens if you put a limit sell? So if you put a limit sell, you're gonna say something like, well, I want to sell 2,000 at, let's call it 560. Okay, again, the market price right now being 545. So what happens again, as the day goes by and the prices go up and down, what's going to happen is you're only going to execute in a limit sale if it crosses 560. So if at some point somebody says, well, I want to buy 100 at 560, then you're going to still have 1,900 left. And then somebody comes in and says, well, I want to buy this many at 561, they will execute at 561 for you. Okay? So this is basically the way the limit buy, limit sell works and how the price in the market is determined. Alright, I'll be making more videos about how the stock market works in investing for beginners. Thank you for following Professor Choi and thank you for watching my videos. Have a good one.